So studies have shown that people would rather talk to their kids about sex than talk to them about money. Apparently, it's that uncomfortable a conversation. And, you know, we're bombarded every day with people suggesting things that we should buy, and that's great. And conferences like this are obviously about buy ideas and learning about opportunities and things that are going on in the investment space, and that's great. But what I've noticed over the years is there's almost no conversation about how or why or when to do certain allocations. And, you know, that's true of the school system. No one ever teaches us. So if we never learn anything about money when we're growing up, and parents don't like to talk to kids, even if they do know, you know, we end up as adults and we're bombarded with buy ideas and no one knows how to allocate their resources. So in the 30 years that I've been a lawyer, a financial analyst, a money manager, I've seen that there are actually what I've distilled to get through it quickly here into 10 timeless truths. And these are big picture things that I think everybody needs to understand. It's like people are trying to pick art and furniture for buildings they haven't yet built. They're not sure how to structure anything. And that can be very dangerous and problematic in our finite lifespans. So let's continue with these timeless truths. So obviously, I think these are obvious, but honestly, I talk to people every day who it seems like they haven't heard this stuff before. So, you know, it's not about what markets do. Media and coverage and in the investment sector's got us all focused on, you know, running around in case, you know, don't want to miss out, prices are going up, you better get in, all that sort of thing. When it comes to real estate, when it comes to any asset class. And reality, it's not what markets do, it's what we do that matters in terms of how much wealth we build for ourselves over time, how much we keep. You know, the reality is that people with the biggest incomes tend to waste the most. Otherwise, we wouldn't have athletes and celebrities of all kinds going bust repeatedly. And a lot of them will tell you, "Ooh, I made so many mistakes." And the more money you have, the more magnified the mistake. And the later you are in life, the harder it is to recover. So it's not what markets do, it's what we do that matters the most. This whole thing about cash being trash, we've got to stop this. Very few people in the world have cash. That's the reality. Again, the finance sector, the investment business, they're all about trying to get us to give them our cash. That's why they tell us it's trash. But in reality, cash is the lifeblood of everything. You know, it's the lifeblood of paying your bills, it's the lifeblood of the investment opportunities. If you don't have cash when opportunities actually present at great valuations, you're going to be, you know, they're not going to be any use to you. You won't be able to do anything with them. The other major mistake that I've come across repeatedly is people think that they have this mentality, you know, it's like your money's a dog team and you have to whip it at all times. So if you have, for example, money or equity in your home, people will say, well, you got to get that working for you. You should get that working for you. It is working for you. It's your shelter. That's what it is. You've already decided to put aside a certain amount of your net worth into a house. That's the purpose of it. It's a consumption asset. It's a really important asset to have shelter, but it's a consumption asset. If you want to make your house an investment, you should put an apartment somewhere in it where you rent other people space and they pay for you to live in your house for free. That's how you make your house an investment, not by gouging out the equity to spend it in consumption or, God forbid, in buying other assets, right? It's the Smith maneuvers of the world. This is a nightmare in real life. And I know it's tax deductible and all that. It increases financial fragility. And the other problem is when you're waiting to buy something, and I come across this all the time, people will say, I've got $200,000 in the bank, I don't need it for 2 months. What should I do? What should I buy with it? If it's already earmarked for something, you shouldn't buy anything with it. You should keep it in cash or a short-term GIC or savings. Don't try and speculate in the short term with money you need or have already committed. So that's very critical. This whole issue of how much we should have in you know, Australian bonds or Japanese yen, or it's all esoteric conversations. The reality is we need to have most of our money in the currency we pay our taxes and bills in. So again, big picture, if you're looking at you have some savings and you're a Canadian, most of that money, 75, 80% of it, should be kept in Canadian denominated things, because you don't want to face unnecessary currency risk. Currency risk is huge. If you're in assets or of a different currency and they start falling in value, it can wreak havoc on you if you're needing income off that money, or you're needing to use it again for something you had earmarked in another currency purchase. So keep that perspective in mind. When you look at your savings, make sure you don't start allocating all sorts of things to other currencies. This is another big one. So this is classically someone who, for example, is working in the mining space, working with a junior resource company. They're exerting all their life force and energy into getting that enterprise going. I have huge respect for entrepreneurism. I've started a couple of things myself. I get it, tons of risk. The wrong thing to do, though, is then to take all of the savings that you start to accumulate, hopefully if your business is going well, and plow it back into the same sector where your income is dependent. This is tech workers in 2000, right? They were working for Microsoft. They take all their savings and put it in Microsoft shares, or oil executives or oil workers who put all their money into oil shares. This is not what you want. You have to have some negative correlation so that if, God forbid, something happens to your income because you get laid off or you have a downturn in the economy, you have less money coming in, you want your savings to be the buffer it was intended to be, and not some wild, volatile thing where you end up losing your banana because you're so stressed out. So borrowing magnifies risk. This goes back to the thing. There's a whole world of people, financial consultants, even accountants I've met, who will tell people that you should borrow because it magnifies your gains. Borrow to buy things. Yes, but it magnifies your risk. It magnifies your loss is huge. We have a whole economy today that's extraordinarily levered because so many people have taken this advice and they've borrowed off of one thing to buy another thing, and they borrowed off that to buy two more things. And what happens in this environment is what we're seeing right now, is what we saw in the 2007 downturn, where all of a sudden assets start plunging, and guess what? The debts borrowed against them do not. So you think lots of talk about the state of household balance sheets being the best they've been in many years. That's only because the asset size has become so highly inflated. I mean, let's not forget the Canadian housing basically doubled in the last 4 years. So you talk about the most widely held asset that has gone up that much. And yet I meet people every day who are shocked to learn that housing could go down 10, 15, 20, 30%. No, they say, that's not possible. I say, you do realize it doubled in the last 4, right? The whole momentum from investment returns over time. So you know all those charts that everybody shows you, the TSX index, the S&P 500. It looks like such a great, obvious line, stocks always go up, right? Except they don't. And in 10 and 20-year periods, they can go sideways or down and not come back for many years. So this really matters. The other thing that people don't appreciate is the bulk of that line is actually driven by the dividend payments that are presumed to be reinvested. So if you're an average person that pays fees to your advisor or broker or whoever it is, that money's coming out of your dividends or your interest that's coming into the account. And if you start withdrawing money for spending, which most people do in retirement, then you're not going to get that line, because 4 of 6 returns over the last 200 years have come from the reinvestment of those dividends. So when you get into a period of time where no one's talking about the dividends and everybody's only expecting things to go up, that's the very nature of a speculative episode. They don't understand that income and compound returns are actually the thing that drives gains over time. It's really important to understand. So the smartest thing we can do is try and design to spend less than we earn, to not retire too early on some expectation that, you know, we're going to make 7 or 8% and obviously it's all going to work out. I meet people every day that are retired way too early. So I have this analogy of people, you know, they get in, they say they want to be driven. I live just north of Toronto, but say, you know, an hour drive. They get in the car, I say, where do you want to go? They say Toronto. I say, fine. I've got a state-of-the-art vehicle, very, very safe. I've got all the technology to protect you. Just sit in the back, put your seatbelt on, and we'll be there in about an hour. Great. You start driving, you get on the 400, you're going 120, and all of a sudden, they start jumping out of a moving car. This is how people respond to volatility. Everyone says, in surveys, what would you do? How do you feel about volatility? And people always say, I don't mind it. Yes, you do. You don't mind it so long as the volatility is a positive skew. But as soon as volatility starts going to the downside, everybody hates it. So the way that we have to protect against that very nature of us is to smooth the ride, to drive slower so that you won't want to jump out, and or if you do, you won't kill yourself, right? So that's why it's very important to have a smoothed out portfolio, not a highly concentrated risk exposed one that's going to swing all around and freak you out at the wrong times. Here's a news flash for you. Most gurus that you talk to are horrible at this too. Horrible. I can't tell you how many people I've known in the years who are experts, whether they were professors in university, in MBA programs, CFAs. They're the ones who know all the theory, and yet they've continually blown themselves up. Typically, their spouse will no longer let them have access to their savings accounts because they've hurt them so badly through cycle after cycle after cycle. They always get uber confident when prices are really high, and the reverse when prices start going low. So it's a whole different mindset you have to appreciate. It is a cycle. Everything's a cycle. So in this example, this is stocks versus bonds since 1970. So you'll hear this, bonds are for dummies. When someone's telling you bonds are for dummies, they're trying to sell you risk. Because bonds, in fact, are the main component of stable income reinvestment over time. The least risk exposure, capital guarantee at maturity, something equities don't give you at all. There is no requirement to give you back your money. There is zero guarantee that they ever will come back to what you pay for them. And there's no contractually prescribed income that has to be paid. Yes, they can pay you a dividend, but management can and should skip the dividend when the company needs to, when it has to rebuild its coffers or when it gets into a challenging period. So it's a completely different vehicle. Equities for sure are there to play a role for longer term money and hopefully compounding income being reinvested. But when you are in a period where, over the last decade, stocks, because we have had such a highly levered, such a highly juiced environment, crazy risk taking, central bankers front-running their own decisions, politicians, making decisions in accordance with their stock portfolios. I mean, it's been crazy. And when you have that kind of environment, stocks go up a lot, too much. They've gone up too much. So when you look at days like today where everything is crashing and liquidating all at once, and people think, I don't understand, why are tech stocks going down, but so are the banks, so are the pipelines. Why is it? I thought that was defensive. Because we're in a highly levered, interconnected environment where everyone has gone long risk trades with too much concentration. Bonds are the least held asset class right now, and the least that anyone's had them in more than 40 years. So when you see that kind of an outperformance, that means you're near a cycle top or possibly already had the cycle top, and then you're likely to see stocks underperform guaranteed instruments for potentially years to come, depending on how fast this happens. So risk moves up and down with price, not the other way around. We love things on sale at grocery stores or at the mall. But when we're looking at investments, the higher the price, everybody wants in. When the price is low, no one wants to touch it, right? That's our whole human psyche. So the other thing we have to appreciate is that great companies here, awesome space, very exciting, lithium, nickel, all these great batteries. I drive an electric car, have for years, love it. Charge it for $5 in my garage. Talk about smart financial decisions. That's what we're talking about. Money that doesn't burn out of you. That's not a tax. That helps you build your savings. So anyway, those are all great, but I don't own Tesla shares because they're overvalued to such an extent that you start to see them dropping. They're off about 35% or maybe more today. Everything's down about 5 or 6% at the moment, just today. And you see some of these companies, everyone says, well, Apple is great. Everyone's got an iPhone, yes. And it's been going up through this period of incredible liquidity, and it was trading at many times sales. That's not an investment anymore. That's a speculation. And when everybody holds the same thing, you start to see the price go the other way. ARC Investments is a fund that was buying all these innovative technologies, right? And great, like very good stuff. I agree. They have high prospects of returns potentially over the next decade, depending on which companies make it, because a lot of them won't. A lot of them will fail. Think of 2000. The internet was coming in. The tech stocks were all the rage. Absolutely. But that didn't mean that Cisco didn't go down by 70% and stay flat for 15 years thereafter, and it still made market share. It still gained market share, but the price was the problem. So the ARC Investments company buying all these great companies in the tech space, and then they're down 70% in the last 18 months. And everyone's like, but I thought they were great companies. I don't get it. Isn't that the future? Someone asked me about the Metasphere. Isn't that the future? Yes, but don't expect overpriced companies to be great investments. You've got to pay the right price, like cheap. It's got to be cheap because the prospects of failure are high. So the cheaper you get it for, the lower your risk in that company. Same with defensive equities. This is classic. People say, well, if you think you're going into recession, a bear market, own defensive equities. This chart just shows you that defensive equities have routinely lost 25 to 50% as well in this kind of environment during recessions and bear markets over the last 20 years. So don't expect equities to decouple when we get into a bear market from these high liquidity assets. And metals and the loonie tend to fall with equities in this environment. So this is copper, silver, gold. We went through this in 2007. I was at these shows. Everyone was in love with the metals complex because it had gone up a lot. And they thought China could never get enough and all that, but the problem was price. And so yes, China's bought a lot of metals and accumulated resources, but these things still crashed, 50 to 70% depending on the actual company and leverage and that sort of thing. And the Canadian dollar tends to trade down with them. Now that doesn't really matter for Canadians if you have the bulk of your savings in the Canadian dollar and the bulk of your bills are in the Canadian dollar. You're not exposed to that huge volatility. But with a portion of your money, perhaps up to 20%, you can have some US dollars, as an example, as an investment on the idea that it's one of the few things that goes up when all these other risk assets come off. So I've run into so many people with crazy portfolios in the last couple of years. I mean, there was a couple who had 80% of their money in Tesla, and they want to know what they should do with the other 200. They weren't the other 20%. They weren't worried about the 80% in Tesla. They were just worried about the other 20 because it wasn't doing much. Well, that's not diversification. That's extreme risk exposure. And in fact, it's begun to fall a lot. And a loss of 70 to 80% is typical. It's typical after these kind of bubbles. And then you have to make back, 235% just to get back to even, and it often takes years. So that quick V down that we had in March 20, that wasn't a bear market, by the way. That was a crash, but it quickly reflated. And the people that think they've lived through a bear market because they bought the dips in that and now they thought they were a genius, that's not a bear market. A bear market is a couple of years of grinding people down till they quit. Till they jump out of the moving car, roll into the ditch, and go into a fetal position. That's what a bear market does. But it doesn't have to. If you don't go into it levered, if you don't go into it highly exposed, if you go into it with your cash, knowing it's the most valuable thing. So I was contacted in 2011 by someone who we refer to as Silverman in our office now. And Silverman, bless him, told me that he had recently retired. He was in his early 50s. Him and his wife had retired. He was building his dream home, and he had a portfolio of about $10 million. I said, oh, okay, interesting. So he wanted to know what I would do with the $10 million. So I started to ask him questions. He said, well, first of all, what are you doing for income? Oh, I just take money out of my portfolio when I need it. So what income, what assets do you have? I have 2 silver company shares. 2 junior silver company shares. Excuse me? Your entire portfolio is 2 silver junior minor company shares? Yes. Okay. So you've quit your job, you have no income, and you're in these 2 things. Why in the world haven't you sold any of it? Because it's going to be worth 15 in about 3 weeks, he said. The other kicker was, I asked him how much the house he was building was, and he said $4 or $5 million. He wasn't sure. I said, where's that money? Oh, it's coming out of the 10 that's soon going to be 15. So suffice to say that silver crashed, by 50% basically, and it hasn't come back since. And I don't think it worked out well for Silverman. And I say that with the greatest empathy. But when I told him that he was batshit crazy, he thought I was, and he went somewhere else. And, probably some person put him in and maybe borrowed, probably took out on margin against his 2 junior mining shares so that he didn't have to sell anything, because you don't want to trigger any tax, So you took your money out on margin to build this house and then get a big mortgage. That is a nightmare. And yet it's very classically done, recommended, followed. So sizing matters. I know I'm almost out of time, or I am. So basically, if you're 60 years old, I'm 57 years old. So say I was 60, I'm 75% through my likely longevity if I get to live to be 80. It's hard to imagine, but it's true. You think about it that way. Wow, right? All right, 75%. So what kind of time horizon are you thinking you have? How long do you think you have to have money work out, to have it start paying you an income in your retirement and all that? So my point is, you need security of principal with a big chunk of your savings. And yes, bonds have volatility, and they've sold off in the last year because of all this talk about aggressive rate hikes, but they mature at face value. And I'm not talking about corporate debt, junk bonds, all that sort of thing. You buy those at the bottom of the equity cycle because by then they're trading for 40 or 50 cents on the dollar, and you could put maybe 5 or 10% of your money into something like that, and you'll get yields of 8, 9, 10%. But again, sit down and set out what your max exposure is to these things. How much of your money can you afford to be going 100 miles an hour in the reverse and you not have a problem? And then also think about, if you're going to be allocating to something like a resource sector, it shouldn't be more than 15% of your whole savings. A 5% maximum for an individual issuer, that's quite a bit. If that 5% doesn't work out, you've lost 5%. But if you put a lot more in, it's going to leave a big mark and it's going to be hard to recover. So it's really important to sit down and make your allocation rules. Very few people will talk about it, but it's key. So it's always about behavior. That's ultimately what decides, how you do at the end of a cycle, how you do at the end of your life, what kind of actual seed corn you've got stored, how you're going to make out through your retirement, if your spending is not more than your income, if you're doing intelligent things to be efficient and productive. All that really, really adds up over a lifetime. Thank you very much.